Good day Forex trader. Your USD Forex signal, more downside amid Fed, ECB divergence. The pair will likely keep falling as bears target the key support at 1.1180. Bearish view. Sell the Euro USD and set a take profit at 1.1150. Add a stop loss at 1.1300. Timeline, 1 to 2 days. Bullish view. Set a buy stop at 1.1250 and a take profit at 1.1350. Add a stop loss at 1.1150. The Euro USD pair continued declining on Monday as investors focused on last week's decisions by the European Central Bank, ECB, and the Federal Reserve. The pair also reacted to the happenings in Washington and the rising number of Omicron cases. It is trading at 1.1235, which is lower than last week's high of 1.3560. ECB and Fed divergence. Last week was the most important one for the Euro USD pair as the Fed and the ECB delivered their rate decisions. The ECB decided to leave interest rates unchanged and signaled that it won't hike rates anytime soon. The bank hinted that it will only hike rates when it ends its quantitative easing, QE. It signaled a bit of concern about the Omicron variant that is spreading across the European Union. On the other hand, the Federal Reserve decided to leave interest rates unchanged between 0% and 0.25%. The bank also decided to increase the size of its tapering to about $30 billion. As such, the bank signaled that it will end the asset purchases in March next year. It also expects that it will implement 3 rate hikes next year. Therefore, it is clear that the Fed and ECB have diverged on their policies. The Euro/USD is also reacting to the happenings in the United States. On Sunday, Senator Joe Manchin of West Virginia warned that he will not support Joe Biden's Build Back Better, BBB, social program. This is a $1.75 trillion bill that will provide significant financing to families and climate change initiatives. Without his vote, it means that the bill is doomed. This is a major setback for Joe Biden as we move into a midterm year. Euro USD forecast. The Euro USD pair has been in a major bearish trend in the past few weeks. The pair fell from a high of 1.1690 in October to 1.1188 in November. That was about 4.4% decline. It is now trading at 1.1235, which is about 0.5% above last month's low. The pair is also below the key support level at 1.1357, where it has struggled to move above in the past few weeks. It has also moved below the 23.6% retracement and the 25-day moving average. The Relative Strength Index, RSI, has also moved slightly below the neutral level of 50. Therefore, the pair will likely keep falling as bears target the key support at 1.1180. GBP USD Forex signal, more sell-off expected as cases surge. I suspect that the pair will likely keep falling as bears target the next key support level at 1.3150. Bearish view. Sell the GBP USD and set a take profit at 1.3150. Add a stop loss at 1.3300. Time, 1 to 2 days. Bullish view. Set a buy stop at 1.3250 and a take profit at 1.3350. Add a stop loss at 1.3150. The GBP USD pair declined on Monday morning as the number of COVID-19 cases in the UK continued. The pair also declined as the market reflected on the latest decisions by the Bank of England, BoE, and the Federal Reserve. It is trading at 1.3237, which is about 1% below the highest level last week. UK Omicron outbreak. The UK has emerged as one of the leading countries affected by the Delta and Omicron variants of the virus. On Sunday, the UK government confirmed more than 90,000 new COVID-19 cases, the highest level since the pandemic started. 12,000 of these cases were of the Omicron variant. As a result, the Boris Johnson administration is under intense pressure from experts to impose new restrictions to curb the spread. In a statement, Chris Hobson, the head of the NHS said that new restrictions will be needed. At the same time, Johnson is under pressure from his party and even Conservatives. On Sunday, it was reported that Lord Frost, the Brexit minister, had decided to quit. Other ministers are considering quitting as Johnson's approval rating declines. These events are notable because of the actions by the Bank of England, BO. After sounding cautious a few months ago, the bank came swinging last week and decided to hike interest rates by 0.25%. It also signaled that it will hike rates in the coming year. It noted that higher interest rates were necessary in order to shield the country from higher inflation. Still, it is unclear whether higher rates will slow inflation because it has been caused by the ongoing supply chain challenges. The GBP/USD is also falling after Joe Manchin said that he will not vote for Joe Biden's Build Back Better plan. Without his vote, it means that the plan is doomed to fail. GBP/USD forecast. The 4-hour chart shows that the GBP/USD pair has been under pressure in the past few days. The pair has managed and moved slightly below the 25-day moving average. This is a signal that bears are in control for now. At the same time, the pair's MACD has formed a bearish crossover pattern while the Relative Strength Index, RSI, has been in a bearish trend. Therefore, I suspect that the pair will likely keep falling as bears target the next key support level at 1.3150. This view will be invalidated if the price rises above 1.3300. AUD/USD Forex signal, sell off to continue for now. There is a likelihood that the pair will keep falling as bears target the oversold level. Bearish view. Sell the AUD/USD and set a take profit at 0.7050. Add a stop loss at 0.7200. Timeline, 1 to 2 days. Bullish view. Set a buy stop at 0.7150 and a take profit at 0.7250. Add a stop loss at 0.7050. The AUD/USD retreated in the morning session on Monday as investors reflected on the recent interest rate decisions by the Federal Reserve and the Reserve Bank of Australia, RBA. The Omicron variant is also affecting the pair. It is trading at 0.7125, which is slightly below this last week's high of 0.7225. RBA and FOMC decisions. The key driver for the AUD/USD is the recent interest rate decision by the Fed and the RBA. 2 weeks ago, the RBA made its decision. The bank predicted that the Australian economy will continue doing well in the coming year. It also warned that the Omicron variant would pressure the economy. The bank then decided to leave interest rates unchanged and then continue with its quantitative easing policy. On Tuesday, the RBA's minutes will shed more light about its policy and what we should expect in the coming year. The Fed, on the other hand, concluded its meeting last week. In it, the bank decided to leave interest rates unchanged. It signaled that it will implement 3 rate hikes in 2022, higher than what analysts were expecting. Some analysts expect that the first interest rate hike will come as soon as March. Most importantly, the Fed decided to tweak its quantitative easing, QE, program. It decided to double the amount if taper to about $30 billion. It expects that it will end the QE program in March next year. Therefore, with the Fed and RBA decisions done, this week's economic numbers will have minimal impact on the pair. That's because the market participants already know what the banks will do. Some of these numbers include the US GDP, consumer confidence, and existing home sales data. AUD/USD forecast. The AUD/USD has been in a strong bearish trend in the past few months. The pair managed to decline from 0.7555 in September 29 to about 0.7000 this month. This is about a 7% decline and is mostly because of the strong US dollar amid an expectation of a hawkish Federal Reserve. The pair has bounced back and is currently trading at 0.7125, which is about 2% above the lowest level this month. It has moved back to the 23.6% Fibonacci retracement level. Also, the pair has moved slightly below the middle line of the Bollinger Bands while the Relative Strength Index, RSI, has declined slightly. Therefore, there is a likelihood that the pair will keep falling as bears target the oversold level. This will see it retest the key support at 0.7050.